Welcome back to We Are Cosmic, the channel where we don't just talk about crypto hype, we break it down like real market analysts and understand what is actually building behind the scenes. If you are serious about cryptocurrency, especially XRP, you are in the right place. Right now, something important is developing, and most retail investors are either confused, distracted, or looking at the wrong signals. We are not here for noise, we are here for clarity. Because when regulation, institutional infrastructure, and on-chain upgrades all start moving at the same time, that is never random. That is preparation. And today, we are going to talk about three powerful forces converging: the Clarity Act, the XRP ledger upgrades, and what some respected XRPL validators are calling the potential flip-the-switch moment. Before we go deeper, I want you to do something. If you appreciate clear professional crypto analysis, type an X in the comments. That tells me you are part of this long-term vision. Also hit the like button so this kind of serious crypto discussion reaches more people who are tired of speculation and want understanding. Now let's break this down calmly and professionally. First, the Clarity Act. Many people hear the name but don't understand what is actually happening. The issue slowing everything down right now is not whether crypto should exist. That debate is mostly over. The real battle is about stablecoin yield. This is where the banking industry and the crypto industry are in direct conflict. Crypto companies like Coinbase want to offer yield on stablecoins to customers. From a market perspective, that makes sense. Yield creates incentive. Incentive creates adoption. Adoption creates liquidity. Liquidity creates growth. But traditional banks see this as competition, and the banking industry is extremely powerful. They have more capital, more political influence, and decades of regulatory relationships. They do not easily give up control over financial flows. So what we are witnessing is not random delay, it is a power negotiation. The important update here is that major banking institutions are scheduled to meet with crypto industry representatives on February 10th. That meeting is critical because it shows this is moving from conflict to negotiation. When industries negotiate, it means regulation is getting closer, not further away. And if we zoom out and look at prediction markets, there is currently around a 55% probability that the Clarity Act gets signed into law in 2026. That may not sound extremely high, but in political terms, that is significant momentum. Spring 2026 is being highlighted by analysts as a key window. Why? Because once midterm elections approach later in 2026, political priorities shift. If it does not move before that window, it could get delayed further into 2027 or even 2029. So timing matters. Now let's think strategically. If regulation becomes clearer in 2026, institutions will need infrastructure ready before that clarity is finalized. Big capital does not wait for laws to pass. It prepares early. And that brings us to the XRP ledger itself, because while politicians debate stablecoin yield, the XRPL is upgrading quietly. On February 18th, permission domains go live on the XRP ledger. This is not just a small technical tweak. This is infrastructure built specifically for banks, institutions, and regulated capital. Permission domains allow controlled environments inside a public blockchain. That is exactly what institutions require. They need compliance, access control, and regulatory structure before deploying serious money. Former CTO David Schwartz has emphasized that this type of upgrade is what enables real institutional adoption. Not speculation, not hype, adoption, and this is where many retail investors miss the bigger picture. They focus only on daily price movements. But infrastructure upgrades are long-term catalysts. When infrastructure and regulation start aligning at the same time, markets eventually respond. Now add another layer. XRP on exchanges has dropped significantly. Reports indicate only around 1.7 billion XRP currently sits on exchanges, the lowest level in 7 years. Lower exchange supply means reduced immediate selling pressure. If demand increases while supply tightens, basic economics applies. This is what some call a supply shock setup. Now, we are not predicting explosive moves overnight, but we are recognizing structural positioning. And when respected XRPL validators begin talking about a potential flip-the-switch moment, referring to Ripple payments integrating directly into the XRPL DEX, that signals something deeper. If retail-focused decentralized trading infrastructure becomes connected to institutional payment flows, volume changes dramatically, liquidity changes dramatically, and liquidity drives price discovery. Right now, XRP price is around 1.43, and technically we may be seeing what traders call a dead cat bounce after a recent pullback. Short-term price action can look weak, but professional investors look at structural developments, not emotional candles. So the real question is not what XRP does today. Most retail investors think regulation is simply good or bad for crypto, but professionals understand that regulation is about structure, and structure determines where capital flows. The biggest holdup right now is stablecoin yield. On the surface, this might seem like a small issue, but in reality, this is the core of the conflict between traditional banks and crypto-native companies. Here's why. Banks make money by holding your deposits and lending them out. That's their business model. When you deposit dollars into a bank account, they use that capital to generate yield. In return, they may give you a very small percentage. Now enter crypto. Companies like Coinbase want to offer yield directly to users through stablecoins. If customers can hold digital dollars and earn competitive yield without relying on traditional banks, that shifts financial power, and that is what makes banks uncomfortable. This is not about whether crypto should exist. It is about who controls yield generation in a digital financial system. The banking sector has significantly more lobbying power than the crypto industry. They have decades of relationships in Washington. They have massive balance sheets. They have influence. But crypto has something banks don't: technological innovation and growing public adoption. The scheduled discussions between banking giants and crypto industry representatives on February 10th are extremely important. When powerful industries sit at the same table, it signals negotiation, not rejection. Negotiation means progress. If we look at broader projections, analysts are watching spring 2026 as a critical decision window. Reports from major financial institutions like Goldman Sachs and Citigroup have highlighted this period as strategically important before midterm election season creates political distractions. This tells us something very important. Wall Street is watching digital asset regulation closely, not from the outside, but from a positioning standpoint. If the Clarity Act passes in 2026, we could see phased implementation over 1 to 3 years. That means real regulatory certainty for digital commodities, decentralized finance, and tokenization. But if it fails, uncertainty could stretch to 2027, 2029. Markets do not like uncertainty. Institutional capital especially does not like uncertainty. So what are institutions doing right now? They are preparing infrastructure while waiting for clarity. And this is where XRP and the XRP ledger enter the picture again, because while lawmakers debate yield frameworks, the XRPL is building compliance-ready tools. The crypto industry is no longer operating in rebellion mode. It is building compatibility mode. That is a major shift. The Clarity Act, if structured correctly, would define which digital assets are securities, which are commodities, and how platforms can operate legally. That clarity unlocks institutional participation. Right now, institutions are cautious, not because they dislike blockchain technology, but because they need regulatory certainty before deploying billions. And here is something many retail traders overlook. Institutional money does not move emotionally. It moves legally. The moment the legal framework becomes clear, capital deployment becomes easier. Now think about this timing. If regulation potentially moves forward in 2026 and infrastructure upgrades like permission domains go live in February 2026 on the XRP ledger, that alignment is strategic. It suggests preparation. Permission domains allow regulated entities to operate within controlled environments on a public blockchain. That solves one of the biggest institutional concerns: compliance. Banks do not need fully open anonymous environments. They need structured access layers. If XRPL now supports that, it becomes institution-friendly. This is not retail hype. This is structural readiness. Now let's bring this back to XRP price action. Currently, we are seeing short-term volatility. After a sharp pullback, XRP rallied, but it appears to be struggling to maintain momentum. Some traders are calling it a dead cat bounce. Short-term price movements reflect liquidity conditions and trader sentiment, but long-term value reflects infrastructure and regulatory alignment. If the Clarity Act moves forward and stablecoin yield negotiations reach a workable compromise, we could see a new era of regulated digital finance in the United States, and XRP is positioned directly in that conversation because of its focus on payments, liquidity, and institutional rails. The key takeaway here is this: The fight over stablecoin yield is not a minor technical debate. It is the financial control point of digital dollars. Banks want control. Crypto wants access. Whichever side negotiates successfully will shape the next decade of financial infrastructure. And we are watching that negotiation happen in real time. On February 18th, the XRP ledger will go live with permission domains. This may sound technical, but the implications are massive. Essentially, permission domains are a controlled environment on a public blockchain that allows banks, regulated institutions, and large financial entities to operate securely while complying with regulatory requirements. Think of it this way. Institutions cannot just enter an open retail market and start moving billions. They need legal certainty, structured access, and risk mitigation. Permission domains provide exactly that. This is not just a software upgrade. It is a bridge between traditional finance and crypto-native technology. Former XRP CTO David Schwartz has emphasized that this upgrade is the foundational piece needed to attract serious institutional volume. Without permission domains, banks and regulated entities would remain cautious, limiting adoption to smaller scale transactions or experimental pilots. Now, we are creating a compliant pathway for massive capital inflows. Another critical development is the focus on on-chain finance capabilities. The XRP ledger is no longer just a payment system. It is evolving into a liquidity and tokenization platform that supports lending, FX, and tokenized assets, all with built-in compliance and smart automation. These features matter because institutional investors prioritize efficiency, security, and regulatory clarity. XRP is providing all three in one protocol. What does this mean for the market? First, supply and demand fundamentals are coming into play. Currently, reports suggest that only 1.7 billion XRP are available on exchanges, the lowest level in 7 years. That creates a supply shock scenario. Reduced circulating tokens combined with potential institutional inflows can create significant price pressure upward once adoption begins to scale. Then there's the flip the switch concept. This term has been circulating in the XRPL community, highlighted by well-respected validators like VET. Essentially, the idea is that once Ripple payments integrate directly into the XRP ledger DEX, the network transitions from primarily retail decentralized trading to institutional-grade on-chain volume. Let's break that down. Retail trading is reactive, speculative, and often low volume. Institutional trading involves consistent, large-scale flows and liquidity that can drive long-term growth. Integrating Ripple payments into the XRPL DEX effectively turns the platform into an institutional-ready financial network, increasing both transaction volume and demand for XRP. This is exactly the type of upgrade that doesn't just create short-term hype, it builds sustainable market fundamentals. While retail traders often focus on daily price swings, the real story is in adoption and structural readiness. Additionally, upcoming features like confidential transfers and permission DEX capabilities further expand the practical utility of XRP for institutional participants. Confidential transfers address privacy concerns that large institutions often have, while permissioned DEX features create a compliant trading environment for regulated assets. Here's the professional takeaway. When permission domains go live and Ripple payments integrate with the XRPL DEX, we could see a paradigm shift in how capital flows onto the network. This is not speculation. It's infrastructure alignment. The combination of low exchange supply, rising institutional readiness, and regulatory clarity creates a scenario where XRP could experience meaningful upward pressure once adoption ramps up. This is the stage where professional investors position themselves. They don't wait for the headline price spike, they prepare in advance. Now that we understand the Clarity Act and the XRP ledger upgrades, let's focus on what many in the community are calling the flip the switch moment. This is not hype. It's a technical and strategic term being used by respected XRPL validators to describe a point where XRP moves from primarily retail use into institutional scale adoption. At its core, the flip of the switch is about integration and utility. Currently, the XRP ledger DEX is largely used by retail traders. Daily volume is mostly small-scale decentralized trades. But when Ripple payments integrate directly with the XRPL DEX, this changes everything. It allows regulated institutions to settle transactions, tokenize assets, and operate within compliance rules while using the XRPL infrastructure. Think about the implications. Liquidity influx. Institutional capital is orders of magnitude larger than retail capital. When even a fraction of banks or regulated entities start using XRP for settlement or on-chain operations, liquidity spikes dramatically. This reduces volatility and enables larger transaction volumes. Price discovery: with more institutional participants actively using XRP for real-world payments and settlements, the market starts reflecting true supply-demand fundamentals rather than speculative sentiment. Network effects: more participants create stronger network adoption. XRP becomes not just a token, but a functional financial tool. Its value proposition extends beyond speculative trading to utility, compliance, and efficiency. Validators like VET, who are respected voices in the XRP community, highlight that this integration essentially converts the DEX from a retail-focused trading venue into an institutional-grade system. This is the real flip the switch, because it fundamentally changes the network's role in global finance. Let's also consider supply dynamics. Reports from 21 shares indicate that only 1.7 billion XRP are currently on exchanges, which is the lowest level in 7 years. When you combine this low circulating supply with a potential influx of institutional demand, the stage is set for a significant upward pressure on price. We also need to understand that this is a gradual process, not an overnight event. Institutional adoption requires regulatory clarity, which the Clarity Act could provide, technical infrastructure, permission domains, confidential transfers, tokenization, market confidence, and operational readiness. Once all three align, the flip of the switch can occur. And at that point, XRP's role transitions from a speculative asset to a core operational token in on-chain finance. Another important point: this is why short-term price movements can appear misleading. For instance, recent rallies followed by pullbacks, often called dead cat bounces, may give the illusion of volatility without context. Professionals look past the noise to structural readiness. To put it plainly, price will eventually reflect the real-world utility and adoption. When Ripple payments go live on the XRPL DEX, this creates institutional volume that far exceeds retail activity. That is the defining characteristic of a flip-the-switch moment. Finally, let's consider the broader market psychology. Many retail investors are focused on daily gains and FOMO-driven movements, but professional investors are positioning ahead of adoption events. They watch for structural signals, regulatory progress, ledger upgrades, institutional onboarding. These are the indicators that really matter. In short, the flip-the-switch moment is about XRP becoming functional infrastructure, not just a token. This is when real money begins to flow in and network effects amplify adoption. Now that we've covered the flip-the-switch moment, it's time to look at real-world applications, because infrastructure and integration only matter if they solve actual financial problems. XRP is not just another token. It's being designed as a practical tool for fast, efficient, and compliant payments, and the proof is already emerging with institutional use cases like Ripple payments. Take Bitso, for example. Bitso is a regulated financial platform that provides cross-border payment services. Traditionally, cross-border transactions are slow, expensive, and cumbersome. Banks often take days to settle payments, and transaction fees can be high. Bitcoin and other cryptocurrencies were often touted as alternatives, but in reality, they have limitations. Volatility, slow settlement, and compliance challenges make them impractical for many institutions. Enter Ripple payments powered by XRP and RLUSD. This system provides near-instant settlement, regulated USD-denominated liquidity, and predictable transaction costs. For institutions like Bitso, this is a game changer. It allows them to move large sums of money internationally in seconds, maintain compliance, and reduce operational overhead. This is a real-world problem solved, not just theory. Now let's connect this to XRP as a financial instrument. When XRP is used for settlement, liquidity becomes programmable. Institutions can issue, transfer, and control digital assets directly on the ledger. Transactions are near instant. Compared to traditional wire transfers, XRP moves capital in seconds. Regulatory compliance is built in. Permission domains and tokenized assets mean institutions can operate within legal frameworks without taking unnecessary risks. This is where the network effect kicks in. As more companies adopt XRP for real payments, the utility grows, liquidity deepens, and adoption accelerates. Remember, financial infrastructure is not just about speculation, it's about solving systemic inefficiencies. XRP is doing that in a way that Bitcoin or Ethereum cannot match directly, at least for regulated institutions focused on cross-border payments. Now let's tie this back to price dynamics. The combination of low exchange supply, 1.7 billion XRP on exchanges, upcoming institutional adoption, and regulatory clarity from the Clarity Act creates a scenario where structural demand outpaces available liquidity. That is exactly the setup professionals watch for when positioning for long-term growth. Another critical point is the integration of XRP into the XRPL DEX. Once Ripple payments are operational, the DEX is no longer just a venue for retail trading. It becomes a regulated on-chain financial infrastructure. This allows for large-scale flows, tokenized asset settlement, and compliance-ready trading, effectively creating a new class of institutional volume that drives both utility and market recognition. We also need to consider psychology. Retail investors often react emotionally to price swings, while professional investors focus on structural adoption. When you understand the actual use cases and the infrastructure being built, you see that short-term volatility is noise, not a reflection of long-term potential. Finally, this is why XRP's upcoming months are crucial. With permissioned domains launching on February 18th, Ripple payments integrating with institutional partners like Bitso, and regulatory progress on the Clarity Act, we are watching the alignment of regulatory clarity, technical infrastructure, and market demand. This is the trifecta that drives sustainable adoption and growth in crypto assets. Now that we've gone through regulation, ledger upgrades, flip-the-switch adoption, and real-world use cases, let's connect it all to XRP price dynamics. This is where professional analysis becomes essential because price action is more than just charts. It reflects structural supply and demand. First, let's talk about supply constraints. Reports indicate that only 1.7 billion XRP are currently on exchanges, the lowest level in 7 years. This is critical. When supply is low and demand increases, whether from institutional adoption, new integrations, or regulatory clarity, basic economics suggests upward price pressure. But it's not just supply. Liquidity inflows are about to change dramatically. The permission domains on the XRPL, combined with Ripple payments integration into the DEX, create a channel for institutional capital. Unlike retail traders, institutions operate with massive, steady flows. When that money starts entering the market, liquidity improves, volatility can reduce over time, and prices begin reflecting real-world adoption rather than speculative swings. We've already seen short-term price movements that may appear confusing. For example, XRP recently experienced a sharp dip followed by a bounce. Some traders call this a dead cat bounce. Retail investors often panic or rejoice based on these small fluctuations, but professionals understand these are temporary sentiment-driven movements, not indicators of structural trends. Another key point is the timing of events. February 18th brings permissioned domains. Regulatory clarity could emerge throughout 2026. Real-world payment adoption is accelerating with partners like Bitso. When these events overlap, we could see compounding effects on XRP demand. The market often underestimates how quickly adoption catalysts can change price trajectories once multiple factors align. The flip-the-switch moment we discussed earlier is another driver. Once institutional flows hit the XRPL DEX, retail trading becomes secondary in volume terms. This is a market paradigm shift. Liquidity rises, token velocity increases, and XRP becomes a functional financial asset, not just a speculative token. Professional investors also watch market positioning. They consider how supply is distributed, how much is locked up in institutional channels, and how regulatory frameworks impact legal adoption. Right now, XRP is in a unique position. Low circulating supply, growing institutional readiness, and clear technical upgrades. These factors are what drive long-term strategic positioning, not daily candlestick charts.